All right, today we're jumping into something really cool. It's a tool that's kind of like a financial crystal ball for companies. It's called the Altman Z-score, and it's this incredibly powerful way to get an early warning when a company might be in trouble. So let's get right into it. So put yourself in an investor's shoes for a second. You're looking at a company, right? And on the surface, everything seems fine. But what if underneath disaster is brewing? What if you had a single number, just one score, that could flash a warning sign about that company's hidden risk of going bankrupt? Well, that's exactly the problem we're going to solve. And the solution? It isn't some kind of magic trick. But you know what? It might just be the next best thing. It's this time-tested formula, a truly brilliant piece of financial analysis that's been helping smart people make smarter decisions for decades.
To really get it, we have to go all the way back to 1968. There was this finance professor, Edward Altman, and he had a big question. Could he actually predict if a company was going to go bust? So he developed the Z-score to do just that, to forecast with pretty startling accuracy if a big manufacturing company was likely to fail within the next 2 years. That legacy, that origin story, is a huge reason why it's still taken so seriously today.
So how in the world does it work?
Well, it's pretty genius, actually. It takes 5 totally different but super important financial ratios and boils them all down into one single score. It's looking at how profitable a company is, how much debt it's carrying, whether it can pay its bills, its liquidity, its long-term financial health, and finally, how efficiently it's actually using its stuff to make money. It's like a full physical for a company, all in one number.
Okay, so now let's pull back the curtain and see what's actually cooking inside this thing. We're going to decode the Z-score. But don't get spared off by the math. Just think of it like a recipe. It's got 5 key ingredients, and each one tells us a crucial part of the story about a company's health.
Okay, I know what you're probably thinking. That formula looks intense. But I promise you, it's so much simpler than it looks, really. Each part of that equation is just answering a very simple, common-sense question about the business. Let's just break it down piece by piece.
So, ingredient number 1, which we'll call A, is all about working capital versus total assets. This is the short-term health check, and the question it's asking is absolutely fundamental. Does the company have enough cash, or things that can turn into cash quickly, to cover its immediate bills? It's a pass-fail test of survival, really.
Then we've got B, which looks at retained earnings. Now, this isn't about whether the company had one good year. This is about the entire history of the company's profitability. It's a measure of how good the company has been over its entire life at taking its profits and plowing them back into the business to grow. Now, C is where things get really interesting, because it's all about pure performance. It uses something called EBIT, that's earnings before you factor in interest and taxes, and compares it to assets. By stripping those things away, it asks a super direct question. Forget the fancy accounting. How good is this company at just making money from its core business?
Variable D is where the rest of the world gets to vote. It takes what the stock market thinks the company is worth, its market cap, and stacks it up against all of its debts. This is so clever because it shows you how much of a cushion the company has from the market's perspective. If investor confidence suddenly dropped, could the company's value still cover what it owes?
And our last ingredient, E, is all about pure efficiency. It's sales versus total assets. Think about it. A company has all this stuff: factories, machines, inventory. This ratio tells you how good it is at using all that stuff to actually ring the cash register and generate sales. A high number here? That means you've got a lean, mean, sales-generating machine. Okay, so we've mixed our 5 ingredients, we've calculated the score. And now for the big payoff. What does this number actually mean? This is where the real magic happens.
The absolute beauty of the Z-score is how simple it is to read. You do not need a PhD in finance to get it because it basically works like a traffic light. It gives you this super clear signal. There's a green safe zone, a red distress zone, and that yellow-gray zone in the middle telling you to, slow down and be careful.
Let's put some hard numbers to those colors. If a company scores above 2.99, it's in the green light, the safe zone. The risk of bankruptcy is considered really low. But if it scores below 1.81, that's a red light. It's in the distress zone, and that's a huge warning sign for potential failure in the next couple of years. Everything in between? That's your yellow light, the gray zone, and it's basically the formula telling you, hey, you need to dig deeper here.
So just how good is this traffic light? Well, when Professor Altman first created it, the model was an incredible 72% accurate at predicting which companies would go bankrupt 2 full years before it happened. Just let that sink in. With just 5 pieces of data, it could see trouble coming from years away.
For a single formula, that is an absolutely extraordinary level of force.
So clearly, the Z-score is a seriously powerful indicator. But, and this is a big but, it's super important to remember it's a tool. It's not a crystal ball, and like any tool, if you want to get the most out of it, you have to understand what it's great at and what it's not so great at.
So on one hand, it's an amazing first-pass filter for investors trying to decide whether to buy or sell a stock. But it definitely has blind spots. Remember, it was built for manufacturing firms, so it's not always as accurate for, say, tech or financial companies. It also completely depends on the numbers being accurate. You know, garbage in, garbage out. And maybe most importantly, it's looking backwards at data. It can't predict a sudden market crash or a game-changing new competitor that comes out of nowhere. But, oh man, when you use it right, its power is just undeniable. Look at the 2008 financial crisis. By 2007, a full year before the collapse, the median Z-score for the companies that would eventually go under had already dropped to 1.81. That put them smack dab in the distress zone. The formula was basically screaming a system-wide warning, a warning that for the most part was ignored.
So that brings us to the really crucial point, right? We have this incredibly insightful, historically proven, but imperfect model. So how can you actually use it to your advantage without falling for its weaknesses?
Well, it really comes down to 3 simple rules. First, use the Z-score as a starting point, like a first filter, not the final word on anything. Second, always combine it with other research. You still got to read the reports and understand what the company actually does. And third, always think about the context. Is this the right industry for the score? Do I trust the numbers? Asking those questions makes this tool infinitely more powerful.
Which leaves us with one final big question. In this age of artificial intelligence, machine learning, and big data, is a formula from the 1960s really still relevant? And the answer is, without a doubt, yes. Because the tools we use might change, but the fundamental principles of what makes a business healthy, being profitable, being able to pay your debts, and being efficient, those things are absolutely timeless. And that is what the Z-score captures so brilliantly.